Hello traders and welcome to another video. Today we're going to be talking about the Federal Reserve in America and what the Treasury is deciding to do about bond buybacks. Very important information straight after this intro. All right, so let's have a look at what the Federal Reserve has basically been doing. So firstly, let's start by talking about their balance sheet and what they've chosen to do during this COVID-19 crisis. So here we have the Fed balance sheet increases to a record $6.42 trillion. So that's just an amazing amount of money, and it's yet to be determined exactly what this amount of money coming into the monetary system is going to do over the long term. And I think that's what we're going to be talking about today. The Federal Reserve are obviously scared of what this money will do if it isn't needed. And they're trying to manipulate the markets to find out how much money they really need to support the markets at this stage. So of course, we've seen that new announcement about 2 weeks ago or a week and a half ago that sent the S&P up all the way to almost only being down now around 15% from the previous highs. And that $2.3 trillion was on top of all these other monetary initiatives. So if we have a look at the current Fed balance sheet, we can see that here. And we can basically see that the balance sheet is basically vertical right now, all the way over that 6 trillion, super vertical. And it's been pretty high for a while. So we can see where it was before the GFC, and of course where it is now. And they're starting to taper it off, but look how long it took them to actually properly taper off this balance sheet. They basically were so scared they introduced all these new quantitative easing policies, and they've effectively changed the way people will have to look at monetary policy over the next decades. How we'll have to look at profit earnings ratios and valuations on things like properties and valuations on shares. Everything has been changed due to the biggest country in the world from a monetary standpoint, and really just printing and having those potential monetary presses working overtime. And this is really just, shows you how much money they're pumping into the system at this stage. So millions and millions and millions, in fact, it's billions of dollars each week. And it really is starting to make a difference in the way that we value assets. So let's now have a look at what the Federal Reserve actually said. So here we have the Federal Reserve website. I do recommend for everybody, make sure you're aware of all of the different reserve banks, especially if you're a currency trader or even a stock trader, and read their reports, because it is important to understand some basic fundamentals. Even if you're a technical trader, you need to know what are they saying, because key things in their wording, once a reserve bank of any country makes a decision to do something, they generally continue doing it. And that's what we saw with that quantitative easing. So we'll highlight the most important point. You can see here the week in the future in terms of their announcement on the 20th. They've basically said from the 20th of April, they are planning on purchasing $75 billion, or an average of around 15 billion per day in treasury purchases. Now this is important because if we look at last week, it was larger, and they've continued to change the amount that they're of course purchasing per week. And this depends on, I guess, what the market is doing. The idea behind all of these concepts of purchasing back is to create liquidity, to create stability. And of course, fear is the number one bad thing. If we have fear in the market, fear is the number one thing that leads to, of course, incredibly bearish markets, lack of illiquidity, lack of liquidity, and lack of liquidity leads to mega crashes. And we were starting to see that before the Fed jumped in the other day. Gold, in fact, had some incredibly wide spreads on it, and several countries that had bonds were actually starting to struggle to meet the liquidity. We had bond illiquidity for the first time since the GFC. So the Fed kind of saved that for now. But it is interesting that they're starting to scale back. And I expect this is what there's going to be a lot of to and froing in terms of them scaling up and scaling down these purchases over time. Okay, so now let's talk about what's actually happening in the stock market. So there's three different scenarios to this Federal Reserve decision. Let's kind of use, I guess, arrows and circles to understand it. So one is that the Fed injects the liquidity, and they're injecting liquidity, let's say, at 150 billion per week. Now, if they find that this is a very good amount, then technically the market should just stabilize. What we've seen though, with this much liquidity coming into the market, the US market, as we can see here on the 1 hour chart, has basically gone rocketing up off those lows and reached this high up here. Now, this is because you're basically printing free money for lots of companies to potentially use, and they're going to use that, of course, to be more profitable. And there is an argument to be said that out of this crisis, potentially a lot of people will be fired as a lot of companies are going to realize, well, wait, we didn't need as many employees as we once did. So I think the stock market's really thinking about that. So the first case is that by reducing the amount of money that's being printed into the system, they're trying to stabilize the markets. They're seeing whether the market can be efficient by itself. So if stocks and bonds rise together, which is what's been happening, then you've got too much liquidity potentially. If you reduce the bond purchases, and then if stocks move in the opposite, as in they don't necessarily change or they potentially go up a little bit more, then that's also a pretty good thing for the Fed. Now, the worst thing that can happen is, of course, if they reduce the bond purchases and then stocks and bonds both go down together. And that's where we're going to see, if we saw like a vertical down movement, that's where basically the Fed would say, well, go back to the 150, go more, go 200, go whatever we need to potentially push it back up. So it's a game of cat and mouse with Wall Street. How much money is needed to stabilize the markets through this crisis rather than just printing out of control? Because there's definitely a case to be said here that the Fed is scared about inflation and potentially stagflation, those concepts, and you should read about those if you want to know more, because it is important to economics moving forward. If you print too much money, that is a real problem, even if you're the largest global economy. Now, the second part of today is what I want to talk about was currently what we're seeing with, I guess you would say, metals and commodities that are specifically targeted to the health of economies. So the first one's copper, and copper's often not utilized by retail traders. Here we have copper, and we can see that copper was very, very high pre-GFC, the fall off of copper, and then of course the massive increase in copper out of the GFC. Now, this is a direct reflection of the economy not doing well and people thinking, obviously, things were going bad, because copper basically reflects what's used in the economy. It's used in a lot of infrastructure. It's used in a lot of builds and those types of things. So coming out of the GFC, we saw a massive increase in demand for copper. Copper obviously flew really, really high, and it went so quickly. And we can see a similar thing happening here. We've got this incredible support at around $1.96, and that area potentially could be breached. If it was breached, there's no reason why we couldn't go all the way back down to the previous GFC lows, and that's just due to less demand because, of course, of the virus and the global economy shutting down. Similar story in terms of silver, except silver had an absolute massive peak. Again, a metal that is being used in the economy more than it's being used as a hedge against anything. And we can see that the GFC, coming out of the GFC, and the steep rise, almost meteoric rise of silver over that time. And again, we're seeing weakness, key level support here at just under that $14 kind of 40 an ounce. That's going to be very key. If it gets under there, expect previous lows to be tested. I mean, imagine that silver back at $10. Wow, it's pretty low. Then we've got oil. Oil is another one. Now, I didn't have the chart deep enough back here on the MetaTrader 5 platform, but basically oil is actually way lower than it was during the lows of the GFC, and that's because it's a direct reflection of demand. There is so little demand for oil for the amount of barrels coming out, and even what we saw with OPEC could not hold oil at a very high rate. So basically everyone's kind of reneging on that deal. The deal doesn't seem to be that great for anybody. So while they might be slightly limiting the barrels, there's just not much demand, and cost or contango effect and all these things go into working out oil price. So this is one to watch, and we will watch this on the channel moving forward. And then of course, the last one, which is the S&P 500. We talk about this all the time, but basically it is at the correct level for it to have a bit of a breather and potentially move down, with first kind of profit target levels, if you were shorting this, probably around this 26.36. And I would say that the Fed will be interested in keeping a lid on the stock market to a degree. They don't want it to get out of control, even though a lot of memes and everybody will be thinking that's what they want to do. Ideally, they are concerned about the long-term ramifications of printing so much money. So if it's needed, they might do it. If it's not needed, let the market to a degree have its own control of its own destiny. And that's very important. You need the market to have control of its own destiny. So hopefully this helps everybody today. It's very interesting to see what the Fed are doing. Make sure you watch that stuff, keep on top of the news, and we wish everyone great trading in the next coming weeks. Please like, subscribe, and comment, and ask us any questions if you'd like. And remember to join our Telegram group. We have a public one, it's free, and there's almost 500 members in there, so we'd love to see you in the Telegram group very soon. Thanks very much. Bye.